Hey guys, sorry I missed the next button
Hi,
to,
Hi,
to
Ed.
join. How are
Hey
we doing?
Ed, how are you?
Very well, thank you. How are you guys?
All right.
Good, good.
We are hanging in there. Let me just make sure we are live. I think we are live. Yes, we are live. Perfect. So, why don't we start with some introductions, and we'll start off with our guest of honor. We'll start with Ed. We'll go through Manos, and we'll go into the, and then Steve, and then myself. Let's go. We'll start.
No, it was. It's a privilege to be here, guys. Thanks very much for having me on. My name's Ed Krawiecki. YouTube channel's 5 Minute Investing, Ed Krawiecki. Yeah, great to be on board. YouTube's been good fun and love investing, so fantastic to be on board and have a chat about it.
Perfect.
I'm Manos from Money, Whiskey and Coffee. I do well. My channel is on a hiatus at the moment, but I used to do videos about individual companies and personal finance, and I was focusing mainly on 3D printing companies, EV companies, and companies like that.
Okay, guys. Well, my name is Steve. I'm from a channel called Disruptive Wealth Creation, and it's all about finding opportunities in terms of disruption. And there seems to be a lot of disruption at the moment. Most of it's in the tech industry. So there's things like biotechnology, robotics, fintech, 3D printing, artificial intelligence. So many companies out there that are sort of growing and loads of money to be made. As well as that, I'm also interested in a massive way, more because of my son, cryptocurrency. People like Michael Saylor, I love stuff like that. So I also do occasionally some videos on cryptocurrency as well. So that's me.
That's great. Hi guys, my name is Kaye, and my channel is Invest for Tomorrow with Kaye. And basically, my channel focuses on educating people and walking them through my journey of investing. So very similar to what Ed and Steve does, as well as Mano. So I think that's the common theme among four of us, that all our channels are basically trying to educate investors, or beginners who are on the sidelines, who don't who are worried about investing. So basically, we are trying to educate you or share our experiences with you, and you can use that as you see fit to get into investing. So thank you so much for the introductions. Let's get right into our topic. So today's topic is very interesting. It's stocks versus ETF, and I'll give a little background on why Ed, we got you on the channel. So
Yes.
I was talking to Manos, and Manos mentioned that, hey, you know what? We have this guy called Ed, and he has a plan of not investing in ETF and going all the way through stocks. And I was like, oh, that's a very interesting philosophy, because I kind of agree with Ed on this one. So we'll go through that. But let's start off with first asking a simple question, and we can go through the room as well. What is your stock portfolio comprised of? Like, is it stocks, ETFs, or both? And then we'll get into why and why not. So Ed, why don't we start with you first?
Yeah, so as you kind of hinted at there, I'm 100% stocks. Not that I have anything majorly against ETFs, although there are a couple of reasons why I don't invest in ETFs. But yeah, 100% stocks, very much growth focused. I'm 28 years old, even though I tend to look a little bit older. But yeah, 28 years old, so I've got loads of time for those growth stocks to play out, and I'm looking to really accumulate and grow the value of the portfolio. So 100% stocks with that growth mindset and an approach of very rarely, if ever, selling. I think I've only ever sold one stock in my portfolio. So giving companies time and time to grow and hopefully play out as I hope to see them do it. So yeah, a bit of a different approach, but seems to be working all right so far.
Awesome. And Ed, how long have you been investing in stock market?
3.5 years. It'll be 4 years in February to the day when I bought my first stock. A couple of years before that, I started reading and researching and learning about the stock market. So I learned for a year, thought I knew exactly what I was doing and I had it all figured out. So started with a practice account, and that obviously went fantastically well. Then bought my first stock and lost 800 quid. I lost about 90% of value in my first purchase. So everything that I thought I knew, turns out I didn't, and I lost a load of money, but learned some lessons along the way and been all right since then, thankfully.
Awesome. How about Manos? How about you? I believe you are a more ETF kind of a guy, so why don't you share your
Uh,
thoughts?
yeah, actually, I'm 50-50. My portfolio is 50% ETFs and another 50% is individual stocks. So even though sometimes I double up, so yes, I do have an S&P 500 ETF. I do own stocks from those companies within that ETF individually, so you can say that I kind of double up as well. Also, as Ed said, there are a lot of growth companies that, because they're not big at the moment, they're underrepresented in ETFs. So that's where I focus when I buy individual stocks. I would like to buy growth stocks, companies that have growth potential, but because their market cap is so low, they are like 0.0025 of an all market ETF. So even if they do explode, if they do go higher, if they fulfill their potential, probably you will not see that by holding an ETF. So that's why I think that having both is okay, and also the ETF holding is kind of a buffer. So if I completely mess up my stock picks, the ETF is there, and I don't lose everything, essentially.
Do you also add stocks which are not part of ETFs, or you only focus on stocks which are part of ETF?
Oh, I add stocks that are not part of ETFs as well, even though I do have quite a few ETFs. So I think I have pretty much all the stocks that I currently have, apart from a few real estate investment trusts. All the stocks I have already exist in some of the ETFs I have as well.
Got it. And actually, going back to the question, Ed, do you also own any real estate investments or any other, I know not an ETF, but any stocks which are into real estate?
Not specifically. I don't think. No, it's not an area where I've really jumped in. I think maybe my naivety, but my impression around the real estate stuff is you don't quite see the level of growth that you might do in a technology company, which is the kind of growth I'm looking to get. I think we'll dive into a little bit more of how the portfolio is constructed later. But yeah, I'm looking at, on average for a 20% return a year when I go into an investment. And again, maybe my lack of research and lack of understanding, but I don't think you necessarily see that with a real estate trust as you would do with a technology company.
No, you definitely wouldn't. Real estate investment trusts are mainly if you are building a dividend portfolio. So if you want to have dividends coming in that then you can reinvest those funds somewhere else, then yeah, rates are a really good vehicle for that. But no, in terms of growth, nah.
Yeah, one to look at in a few years' time, hopefully.
Yeah.
Then when I've got a bit of money knocking around.
Yeah.
There's a platform called Fundrise. I'm not sure if it's available in UK or not, but basically what they do is you can invest like a minimum $10 a month, and what they do, they take your money and then they invest in all the real estate projects which are across United States, and kind of give you, I would say, dividends similar to like a dividend. You'll get it. So I have invested in that. It's been about 3 years I've been investing, but it's like the return is like 1%, 3%, 4%. So it's not really changing, your financial conditions. But okay, going back to the question, Steve, what's your take on it? Like, how is your portfolio constructed? ETF stocks?
No ETF stocks at all. I'm like 100% just like Ed. I think we've got the same mindset. So this might be a very short video. Okay.
Yeah, that's a little bit less interesting.
I would like to keep this going on a little bit more. Okay, let's go.
But basically, no. I mean, it's 100% stocks. Simply because, without wishing to brag, I probably, being an older guy, I've got more money, and I don't want to mess about with these little piddling stocks where you get a few quid here, a few quid there. I'm all in 100%. But I also obviously I have a bit of fun with my cryptocurrency as well. So it's mainly just cryptocurrency and 100% stocks. I mean, I have a little bit of knowledge about ETFs and things, but it's not for me. And the one question for Manos I was going to ask, I remember we were talking about ETFs, and you said something about, Nicola's one of my ETFs. Was that right? And you weren't too happy with that?
Well, I have an ETF that invests in hydrogen, and one of the holdings of this ETF is Nikola, which Yeah. Okay.
So you weren't happy with that. So I mean, I don't want to get into the disadvantages, but I just thought I'd throw that one in. Okay.
No,
So
definitely,
that's
definitely.
me, 100% stocks. Okay.
100%. So I think in my case, when I started my journey, I mean, Steve is going to laugh again, but I was just with Apple, and I used to have, I guess, one or two ETFs. That was more like as a starter. That's the general advice everybody gives. Start with the ETF or an index fund. And over my investing period, I have actually removed all the ETFs because I've been in my stock picks, at least I have generated more return on investment as compared to an ETF. Because what happens is a lot of times a specific stock which will run up if you choose the stock, they will trim that stock out of this. So they will keep whatever the asset allocation within that ETF is. Now I generally only hold one ETF, which is IBV, which is the S&P 500 ETF. But that's like 2% of my portfolio or 5% of my portfolio. I generally don't like. I just want to keep an ETF for the sake of keeping an ETF so that I can learn along the way. But if you look at any ETF and you look at their holdings, if they are doing the stock picks and you replicate it, you pretty much are in good shape. You don't really need to pay the index or the ETF, the management fee. So while we're talking about that, so Ed, why did you choose to go this route? What prompted you to just choose stocks?
Yeah, so like I said, I spent a year learning about the stock market, just initially interested of how it all worked, because it seemed like a different language and a different world. But I figured if all those people out there can understand it, then maybe I can too. I'm not sure I still really do. But in the process of that learning and understanding, I came across a podcast, Rule Breaker Investing, by David Gardner at the Motley Fool. And he was the first guy that I came across who was picking stocks and putting his picks out there and actually tracking his success and how successful his picks were. So I think, if I'm right, he'd pick 5 stocks every quarter, and then he'd track those stocks for the next 1, 2, and 3 years. And the numbers and the returns that he was doing with his picks were astronomical. I think he's regarded as one of the best investors of all time. So just luckily came across his podcast. And I got looking at these returns, and the potential was staggering. I thought, if I can get anywhere near that, then that seems to be the way to go. So maybe if I'd listen to a podcast on ETFs and shouting about how ETFs are the only way to invest, then maybe I would have taken a different approach. But luckily came across that. Then I read the Motley Fool book and subscribed to their services and never looked back. And like I said, but apart from my first initial disaster, things have gone pretty well. So I've never really had a reason to change. I think it seems like an approach that's really working for me. And I find it really interesting. I think that's an aspect around ETFs and individual stocks that people don't often talk about. This is a hobby for me as much as it is a financial reward. I love looking at companies and not going as far as reading quarterly statements, but hearing about quarterly statements and what companies are doing next and what Elon Musk is going to do and Amazon delivering with drones. I find it fascinating just looking at where the world is heading. So I think being active in stocks and having a bit of skin in the game with that makes it much more interesting than just lumping into an ETF and forgetting about it. Like I said, I think it's been a good way to make money, but also I find it really interesting.
Now, is that the reason because you personally enjoy investing a lot? That's why you want to go more of a stock route rather than invest and forget it? That's why I don't want to touch the ETF. Is that the right?
That's definitely a big part of it, but also as I'm getting a little bit older, becoming a little bit more self-aware, and I think I do have quite a degree of ego, verging on arrogance. And when I see someone says you can't beat the market and you can't do better than the S&P 500, straight away I think I probably can, because it seems to me like the S&P 500 say that's an average return. So if you say that's the average return, ultimately no one really gets the average, because the average is just that midline. So some people underperform and some people overperform, and me and my arrogance thinks I can be one of those people that outperforms, and so far I have, but who knows over the long term. So yes, being interested, but also my ego and my arrogance to think that I can be one of those people that does outperform.
No, I personally also have a feeling that I think that the statement that you cannot beat the S&P 500 or market, first of all, they're talking from a 100-year data standpoint, right? And even in that measurement, it really depends on the type of people. If you are really a passive investor who just wants to invest and forget and not worry about the investment, I think stocks is probably not the right way to go. If you're an active investor, you are proactively looking for a company, then I'm pretty sure, I think at least most of the people I know who actively manage, they definitely make more ROI on their investment on a yearly basis compared to what S&P or Dow Jones or Nasdaq gives back.
Yeah, and even a couple of % of outperformance over 20 years makes such an enormous difference. So I plug some numbers in. Say an average return of 8% with the S&P 500. It's a little low over the last few compared to the last few years, but on average, 8%. At my current investing rate in 20 years would give me about £475,000 at 8%. If I can get 12% over that same time scale, which I think is achievable, I would make an additional £450,000 over 20 years. So, I mean, even if I fail and average end up with the average, then I've still got 475. But if I can get 2 or 3 or 4% of outperformance, that's life-changing money. I think worth a shot.
Yeah, and Steve's favorite company, Tesla. If you had Tesla, back when it was not part of S&P 500, and you held it through, you probably would have made 3, 4, 5 years worth of S&P returns in just 1 year.
Yeah.
Manos, what are your thoughts? Yeah, go ahead, Steve.
Yeah, I was just going to say I do watch Ed's videos, and the one company that always comes to mind is Lemonade. I'm not talking about the drink, okay?
Yeah.
But I think that company is going to do well. But I was just surprised because I thought you might have chosen SoFi, because SoFi is a company that both me and Kaye invest in, and they're involved in banking and stuff like that. So why did you not choose SoFi?
It's on the watch list to look at soon. It's on the next 2 or 3 down. Just didn't get to it, and probably, well, in hindsight, wish I had, clearly.
Yeah,
because Lemonade hasn't done much for me since.
Well, I did have Lemonade for a while, but unlike yourself, I do actually sell. If I will hold on to shares even just for a few months, and then I'll sell them. So I sold Lemonade, and then I've got other companies. And something that also is very sort of similar to you is I'm also subscribed to Motley Fool. But unfortunately, most of the shares that I invest in are in America rather than the UK. So I'm not really taking much advantage of it. But it's all very interesting. I mean, you've got a lot of, I'm sure you'll explain later, but you've got a lot of companies that are tech companies, like cloud companies,
yes,
to do with insurance and stuff like that. So I'm looking forward to hearing about those.
Yeah, definitely. And just on that point of not selling, I think the money. I almost feel like when I've put my money into an investment, that money's gone. I invest with the expectation of losing that money, of not seeing it again. I think psychologically that takes away the barrier when a stock does go down, but also that pressure on me to want to sell and reuse it. And I think with investing in the kind of companies that I am, who are going through these volatile growth stages, I think that's the approach that I kind of need to take, because I'm definitely not good enough to time to know when a stock's going to go down and when it's going up. I'm backing myself to know or spot a trend or a company within that trend that maybe 5 or 10 years further down the line is going to be a good thing. So I'll touch on it again in a little bit, but Upwork is a good example of that for me. So I bought Upwork shortly after the IPO, and off the top of my head, it lost 85% of its value from there about a year later. So I was down 85%. And that would have been an easy company then to sell at any point of the way down, and think it was probably a wise decision. But since then, a couple of years later, it's now up 211% from my original buy point. So if I'd have sold on the way down, I would have missed out on all that return to come. I think it's just that acceptance of the kind of companies that I'm investing in. Some will be losers and some will be very volatile. But if I buy with that view that the money's gone, and I come and visit again in 5 years' time, I think that's when those massive returns can really come.
Yeah, one thing that I found, guys, just looking at some of Ed's companies, a lot of them, the shares are less than $100 a share. So I know with ETFs it's a lot cheaper in that it's not necessarily that more expensive. You can still find some really good deals and bargains, and like some of the companies that you've got, like Fastly, Fubo, Uber, they're all under $100. So there's some good buys there.
Yeah, no, absolutely. I actually started following Ed as well. Yesterday, I sat down
Thank
and I
you.
did my research. I was like, let me first understand, what kind of investment Ed does. And then it was very surprising to find it. Wow, my thought process, and I'm not the only one, or I'm not the one of the few who only goes this route. So, Manos, what are your thoughts about it? About why do you choose this specific strategy on having ETFs and stocks?
Well, as I said initially in the video, ETFs are great, and they're a safe vehicle. Returns are not guaranteed whenever you're investing, obviously, but an 8% average return beats inflation even now, which inflation is approximately 5% here in the UK. So you are beating inflation again. The other thing is time. So do I have a lot of time, or do I want to spend a lot of time researching individual companies? And if it takes me a month to pull the trigger on a company, all this month I could have just put my money into an ETF, and it would follow the market up or down depending on where that is. Also, uh, sometimes you're thinking, okay, I want to invest in robotics, for example. I know from the top of my head at least 20 companies because of the industry I work in. I'm pretty sure that there are more companies out there that I don't know about. If there is someone that's not working in my industry and they have no idea about which robotics companies they should invest in, but there is a robotics ETF, that's a great vehicle to get exposure to that sector. Buy that ETF, and if you want to buy in the individual companies, obviously every ETF has their holdings, so you can go there, see which companies there are there, obviously, and if at some point you want to sell the ETF and buy those companies individually, you definitely can. However, it is cheaper, in my opinion, if you want to buy the 500 largest companies in the US stock market. It's cheaper to buy the ETF, and you have exposure to all of them, good and bad. Uh, and yeah, you will get an aggregate return. Obviously, you will not get the best return if three companies in the S&P 500 smash it. Uh, this return is gonna be attenuated, let's say, from the rest of the companies in the ETF, and that's something that's a let's say a drawback when investing with ETFs. However, for the average person that doesn't have a lot of time or don't want to spend a lot of time because they want to do other stuff as well, yeah, buy an ETF and yeah, expose yourself to individual stocks as well. Um, Read the boring financial stuff and try to remove your bias when buying a stock, because a lot of the professional, let's say, YouTubers that do professional analysis on a company, they only look at numbers. Say, oh, we're going to look at this company. And they only look at the numbers. They don't say, oh, they make this product, they do this, and they make this acquisition. They only look at numbers. They take their bias out of it, which is something I can't say I can do, especially if I'm looking at a company that I've worked with or a company that I know very well.
Do you
If I
think
know
that's an
their
advantage?
product,
Sorry, do you think that's an advantage or a disadvantage?
it could be both. Could be both. I mean, bias is all human beings are biased one way or another.
Yes.
It could be positive bias, could be negative bias. So if I'm looking at a 3D printing company and I know their product, and I know that their product is good and it's better than company B, but company B is doing so much better financially, I'm still biased. I mean, from a financial perspective, buy company B, even though their product is inferior, because your return is going to be better. But I am biased. I want to buy company A because I know their product is better. That doesn't mean that it will translate in gains, though.
True.
So buying into an ETF kind of takes this thing away from the whole thing. So there are all those things, all those little nuances to take into account, obviously.
So I think what we are saying is that time is one of the most important factors, right? If you are an investor who doesn't have enough time, or don't have the time to invest or research, I think going the ETF route might be an option for you. But I know from what Ed mentioned or from Steve mentioned that because they love what they do, I guess so that's why going the stock route. And also, you can expose to more companies. Not necessarily exposing to more companies, not necessarily means higher gains, but you do I guess there's a better risk management.
And I think sorry Steve, you go, Mike.
So all I was going to say was, I think with new investors or beginners, I think it's always probably a good idea to start with ETFs, and then what you do is you have what they call a satellite portfolio. So you have your ETF, and like what Manos has, you start looking, learning, gaining confidence, and then you'll buy one stock here, one stock there. And then, and as you get more and more confidence, then you think, sling that ETF, let's go for it 100%. I mean, that's just my thoughts anyway.
No, that's a right point. Go ahead, Ed. You were saying something.
I was just going to, Manos touched on it, but one thing that isn't mentioned with stocks is that my level of volatility with my portfolio is pretty massive. Earlier this year, my portfolio dropped 30%, while the S&P was at all-time highs. Now, I thought I was prepared for that. You kind of read and you hear it's going to come, and it's going to come at some point when you're investing in individual stocks the way I do. But actually going through and experiencing that, I think I was down about £16,000 in about 3 weeks, which was a lot of money for me.
Yeah.
And that it should be okay, but actually going through that can be quite a traumatic experience, particularly there's people I can talk to that I can have those reassuring conversations. But if you're going through that on your own, that can be pretty hard to go through. So I think going the ETF route, again, correct me if I'm wrong, but that volatility is certainly going to be much less, a much smoother ride. Even though we arguably due another big drop at some point. I think that's where, for a beginner, or for any investor, if you're not prepared to see that volatility, you don't want to see that volatility, I think the ETFs are probably a better way to go.
Yeah. No, I
definitely.
totally agree. Yeah.
Definitely.
So, Ed, why don't you tell us about your stock portfolio and how it's constructed and why you decided to shape that way your portfolio?
Yeah, so started over here with a broker, AJ Bell, and that kind of formed how I had to build my portfolio, because when I started investing, the free investing and free trading didn't exist in the UK. So I was paying a commission and a fee. So it meant that I had to sort of save up a block and then invest in one go to try and minimize those fees in terms of percentages. So it kind of worked out. I'd save up about £1,000 and then invest that into one company as a lump sum, which if I was starting now, I probably wouldn't do. I'd probably want a dollar cost average in, but in some ways, it's kind of helped, because it means that I have to have higher conviction before I buy into a company. I have to be sure that that's what I want to put my £1,000 to. And it's also meant that my money, as soon as it's available, has got in the market, that there's less faffing around. So I hold about 25, 27 companies at the minute, depending on if you count startup positions. And I've built that as a portfolio. Each started about £1,000 in terms of their positions. And then I've just let them grow from there. So some are bigger than others. The ones that have grown multiple times now take up more positions in my portfolio. And I worked out that the biggest 5 stocks in my portfolio now make up about 35%. So it's kind of self-concentrated a little bit. Still got that diversification, but it has over time concentrated itself a touch.
So, Ed, how do you manage your 27 stocks in the portfolio? It's like, do you think it's a big number, or you're going to increase it further, or you're going to decrease it to make it more manageable?
I think I'm about right with 25 to 30 companies. There's a couple more. SoFi is one. Upstart, I'd like to add more of a position to. There's a couple I've got my eye on, but I think that number for me is about manageable. As I say, because I don't really plan on selling any, I don't have to keep a really close eye on the quarter to quarter. Obviously, I'm keeping an eye because I love it, but the quarter to quarter doesn't really matter for me. It's what happens in 5 and 10 years' time. And if big news changes, then chances are 30 is manageable enough to pick that up. So the company that I did sell was EA Games, the gaming company.
Arts.
So so I was following them and didn't like the way that they were introducing loot boxes and targeting kids and that kind of stuff. But within a 30 company portfolio, I can keep a close enough eye to keep an eye on things that pop up. But yeah, it seems to be manageable so far. There's nothing's massive has snuck under the radar yet.
Awesome. So Manos, Steve, what are your composition? How many stocks you are able to manage in your portfolio?
Well, I've reduced my portfolio. When I started a few years back, I had about 30 stocks, but then what I started seeing was saw a pattern where certain companies were doing better, and then I started actually to sell some of the stocks I had, and then reinvest that money in the ones that the base of ones that I had, the top 10 that I had, which I got more of them, as well as spending more. So my stocks basically, I've actually just recently got 2 new stocks. One's called Marathon Holdings and one's called Hut 8. Now those 2 stocks, what they do is they're mining stocks, but they're mining for cryptocurrency. So as I've gone into cryptocurrency, I thought, oh, actually, you can buy shares that to do with cryptocurrency, and crypto's on the way up, so it makes sense. So I got those 2. Then I got a couple of companies like SQM and Talon. Now these companies are basically mining companies that mine lithium, because I thought, well, lithium, they need lithium for EV cars, so it makes sense after a bit of research. So I invested in those companies. And then I've invested in sort of Desktop Metal, which is a 3D company, and I've invested obviously in Tesla. I've also got some in CRISPR Therapeutics, which is a biotech company. Now that company is not doing too well, but the one thing that I would say to you is that maybe it's because I'm impatient, or maybe it's because I'm 61 and I ain't got much time to go. I can't be hanging about for 10, 20 years waiting for those stocks to go up, man. There are plenty of opportunities out there. So, if my stock is not doing well, I would even be quite happy to sell the stock and go and get some more crypto, because I want them to go up. And why not? That's just my thoughts.
Manos, how about you?
Yeah. So I have about 30 to 35 companies at the moment. I'm not counting ETFs as individual stocks, obviously. But yeah, I have approximately 30 to 35. My issue is not being on top of 35 companies. My issue is that I have exposure to different markets, and in order to do that, I have to have multiple trading platforms. So I do have a free trade that Ed and Steve know about. I also have Fineco, which is another company that gives me access to French, Italian, German markets, because I want to buy stocks from companies over there as well. That's the biggest hindrance of being on top of everything, with the different times that the markets are open in different countries. And
makes tracking a portfolio much more difficult as well.
Yeah, exactly. So you need to go through one app, then close that, go through the other. Yeah, it's a bit of a mess, but it's part of the game, I guess. And I don't really sell like Ed. I have sold a couple of companies when the companies reached my target price and I couldn't see them going any higher. One of them was Nvidia, for example. The other one was Autodesk, when they reached the target prices I had set. So I sold them, and I'll probably enter again at some point in the future. But now I'm focusing mainly on dividend-paying stocks at the moment, and for this reason, I'm primarily looking at the UK market for tax efficiency reasons, obviously.
Just out of interest, what sort of spurred that change of approach? What made you change to dividend companies?
I think I reached the point that I said, okay, I'm good now with growth companies. Let's start finding and investing into dividend-paying companies, and that's why real estate investment trusts are one of the asset types I'm looking at. And I think I'm gonna do it cyclical. So after a few months, I'll go back into looking at growth stocks and then do it that way. I don't want to get a lot from dividends within a year. If I get something like £500, I'll be more than happy. That
That's a
will
lot.
pay.
Yeah.
Yeah, I mean, if I manage to do that over a period in, I don't know, 5 years time, I'll be more than happy because that would pay me. That would pay my plane tickets for a holiday per year
That
without
is
me having to worry about it. And yeah,
That's awesome. I mean, the way maybe it can help you guys, it can help the viewers. The way I do it is, I kind of break down my portfolio into, let's say, on this platform A, I have my private portfolio, right? So this is my main portfolio. On platform B, I have a public portfolio. On platform C, it's like options. So what I do is I kind of break it down. In my private portfolio, I generally I try not to go more than, I guess, between 10 and 12 stocks. 15 is probably at the higher end. And the way I do it is I have like 4 5 very high conviction stocks, and my portfolio will be highly concentrated on those five, and then 2%, 3%, 4%, depending upon the stocks, you'll asset. And then I break down the dividend portfolio separately. So I'm not worried about, okay, this is monthly, I will invest in a dividend portfolio, so you will select dividend stocks as well, and those companies. And that's just one way of adding a passive income. Public portfolio, I'll dedicate X amount of dollars on this one, and I can go and choose a different way. So it kind of helps me to like bucket. Instead of having one portfolio with 30 stocks, maybe I'm doing the same thing as you guys, but what I'm doing is I'm segregating that big box into multiple small chunks and saying, okay, focus over here for public portfolio, focus over here for private portfolio, focus here for dividend, and that's it. So that way I can say, well, my dividend portfolio only has 10 stocks, or my private portfolio only has 12 stocks. So that's how I'm breaking it down. Maybe it just helps me, but I think, yeah, go ahead.
How concentrated are those high conviction ones then? What percentage of your portfolio overall would you say are in your each individual high conviction ones?
So among the first 5 stocks, it's probably 60% portfolio concentrated. And I can give you the stocks names. So it's Apple, Amazon, Tesla, Nvidia. And the reason I structured it that way is because I look at the market, I look at the ETFs. If those stocks go down, regardless of which ETF you own, the market will go down as well. So if I'm structuring it that way, no matter what happens, if I will go down, the entire market goes down with me. So, and unless you are betting against those companies in long term, okay, that may change 10 years down the line. So if it changes, I will trim the position. And what I generally do is I have added covered calls on it. So I'm always trying to make more money from that rather than keeping it safely and making sure nothing goes wrong. I'm making money on that by running covered calls. Now, for covered calls, you definitely need 100 stocks for it. But if you have 100 stock of a particular company, you can run covered calls and generate income. I don't want to sell Apple. That's why I do a short covered call, but that's another topic we can definitely take on. So that's how I do it. And then, of course, dividend portfolio is there, which can generate, like how Manos is saying. I think, I mean, I don't expect to make a lot of money from dividend portfolio. It will probably take me 10-15 years to build that portfolio, where I have seen some YouTubers, they are generating almost $20,000-$30,000 in dividend portfolio.
Nice.
But for that, there's a lot of investment you have to do.
Can I ask a question about ETFs? So this is probably for Manos and Kaye, and that is, would you get an ETF in gold?
I don't think there's a point getting an ETF that only has one asset in it. Why not go and get gold directly?
Right.
There are ways to do it. I have seen ETF, gold ETFs, silver ETFs, platinum, palladium ETFs, all of those. I would only do that if it made sense from a tax perspective. If it makes sense from a tax perspective to have it as an ETF, yeah, I would do that. But if you want to, since you like crypto as well, you should probably look at a platform called Kinesis Money. Steve, they have tokenized gold essentially and silver, and so they are backed 100%. At least their latest audits said that. I haven't invested in them, but yeah, I can send you a link afterwards.
Oh,
But
thank you.
there are ways to invest in
Yeah.
physical gold
Well,
yourself, not through an ETF.
This was the point I was going to come to, because I read somewhere that if you have an ETF, you can actually have physical gold, or you can have other companies that don't actually have physical gold. So what they do is they invest in futures and in options. So they kind of cover. So if the gold goes up and you need the money, because you're selling or whatever, they'll give you the money, but they don't actually physically have the vaults or the gold bars. So that could actually be quite a serious thing, if it goes wrong.
If it's true. I mean, if you're talking about a gold ETF and the ETF only holds gold, then go buy gold. Don't go through the ETF. Take the middleman out of the way.
Yeah.
If there is a gold ETF and says, okay, we have gold, we also have gold mining companies. We also have companies that use gold for electronics or industrial usage and things like that. So there is a broader, the broader gold mining and processing industry. Then that would make sense as an ETF. But you should know that you're not actually buying gold when you're buying this type of ETF, obviously.
Yeah, I had a silver ETF long time back. I bought it because my mom asked me to buy a silver ETF. I don't know why. So I ended up buying a silver ETF. It never did well. So I actually ended up selling in loss.
Did you tell your mom?
No, I did not. I was very upset with her about it. But no, because the funny thing is, like, she actually does trading. So my mom and dad, they have been trading for a very long time. So it worked for them when they used to do gold and silver trading. So it worked for them. So she's like, oh, a tip for you, do silver ETF. I'm like, okay. All right. So getting back now, so let me ask you this question. So Ed, what are your top 5 stocks from your standpoint?
Cool. Yeah. So I had a little think about this question in advance, and rather sort of giving my opinion on the next 5 big things, because honestly, I don't really know. I mean, it would be an opinion and a guess as much as anybody's. I looked at it as almost that I went back and looked at my 5 biggest returning stocks. I think that gives much more of a flavour to my approach and how I've invested, and also I think the potential of this way of investing. So sort of in reverse order, number 5 was Axon. They produce police body cameras and tasers, and increasingly drones and other technologies. But importantly, they also support the cloud servers and the software from which the police can access all that data. So Axon, the stock, has returned 164% for me. Upwork, I touched on before. That's the platform for freelancers and companies and connecting freelancers for projects. That stock's returned 211% for me. The Trade Desk, they operate sort of programmatic and AI-driven advertising, so you can run advertising campaigns simultaneously across all sorts of mediums and devices and get the analytics and turn it on and off. Trade Desk returned 213%. Zoom, the company that needs no introduction, I don't think, was lucky enough to buy them in January last year, so way before any of the nonsense. Again, a complete stroke of luck, but that one returned 256% for me as it stands. And then my biggest returning share is Etsy. So Etsy's the online marketplace for anything craft or vintage or handmade. Basically, all the good stuff that you can't buy on Amazon, you can find on Etsy. And Etsy's up 463% for me. So that's just a bit of an idea of the kind of companies, very much technology based, very, very scalable. Almost, it's kind of like Steve said, with his sort of picks and shovels plays. So rather than the product themselves, they're sort of the middleman and the connecting piece between the product and the user, and then just leaving them long enough to do their things.
True. How about Steve? How about you? What are your top 5 stocks? And let's keep the crypto out of the picture for now.
We'll keep crypto out of it. So my top one is Tesla, where I've made 50% profit on. So I'm very happy with that. And then my 2 mining shares, the ones unfortunately to do with crypto, Hut and Marathon Holdings, they've gone up by about 20%, although I don't have that many of them. And then SQM, which is a mining company that mines lithium and other products, and also CRISPR. So those are my top 5.
How about you, Manos?
So top holdings at the moment, in terms of both performance and position, is AMD. I've done. I'm looking at it now, 24.3%, and Stratasys, which have done 51% actually, and I had no idea until now that I looked at it.
Happy days.
Wow. And actually, this is one of the things that I was talking about earlier. If you would tell me buy a product from Stratasys or one of Stratasys competitors, I would buy from a Stratasys competitor.
What do they do?
From a technical point of view, 3D printers.
That's
From a technical point of view, I would buy from their competitors, but they're crushing it in terms of stock price. So, hey. And in terms of position, how many stocks I have, Aviva, a UK insurance company, is one of my my positions with a large number of shares, even though it's not a big, let's say, position monetary wise. Arrival is another company that I've bought shares to recently. Palantir is one of my conviction stocks, and one of a recent conviction stock that I have is Corsair.
Oh, Corsair, I know Corsair. Yeah.
I don't know if you guys know Jeremy from Financial Education. This is one of his top 5 stocks.
Oh, wow.
Corsair Gaming.
Gaming.
He's a pretty big name in the financial YouTube world.
Yeah.
Very good company.
Well, I bought it mainly because, okay, I am biased. I have a lot of Corsair products on my PC anyway, but their financials make sense and they have a lot of potential in the market, and their PE ratio is really low at the moment, so it looks like it's a very good price to buy. But hey, not financial advice, obviously.
Not financial advice.
See, I would have gone for Skills. Have you looked at Skills?
No.
Yeah, but it's a long story, so we'll not go there.
Okay, fair enough.
Check it out if you want.
Okay, so I think my number one from I guess total returns and percentage wise is Apple. You'll be surprised. Zoom, second one. Okay. Wayfair. I don't know if you guys know a company called Wayfair. Yeah. They sell furnitures, right? That's almost like 900%.
Wow.
I looked at them and decided I didn't want to buy it.
But the funny part is I did not invest a lot of money. So even this 900%, it does not. Then you have Amazon and Facebook. And then I have one Diageo. That's your UK company. So that is almost like 250%. And that I have a lot of money invested in Diageo. So those are I think I gave my 6 stocks.
Why did you buy that one out of interest? It's not a company I would ever have looked at.
It's well, so I generally look for the large companies, and in the distiller, they are the largest company. I think the only for 1 year there was a Chinese company that overtook Diageo as being the largest company in the world. But Diageo being the largest distiller in the world, and the brands they have like Johnny Walker, and those are like, I would say, masterpiece, I guess, brands that everyone knows about it. And no matter what happens, you will still drink. Tesla can go to the moon, but you will still drink, right? Apple can sell everything on the planet Earth, but you will still drink. So there are certain things, you just cannot replace. So I was like, this is something which, I don't know, not many people look at it.
Yeah, and, I would never have done.
And it's like sometimes, you have these diamond in the rough, and, people just like go over it. And funny thing I have noticed, because I used to work for investment management company, and I had kind of learned from them, to be honest, they don't go for all these fancy toys or, the top companies. They are actually looking for those companies nobody looks at. Like Foot Locker, I bought when it was back in March 2020, it was down to like $32, $31. And I sold it at $65, $66. So that's a pure 100% profit right there. And I made a lot of covered calls on it. But and Delta, So all the, like, if you look at my channel, all the stocks I talk about is either I have held it, made profit, or I lost it. Like Nikola, I will be very honest. I mean, I FOMO'd into Nikola. I lost 50-60%, but I always have a, stop loss, and I do dollar cost average. So that's where it protects me on the risk side. But that's how I have done it so far.
Interesting. No, that's cool.
Okay, so now, because we are almost at the end of our conversation, and I don't want to, be disrespectful and hold you for more, because I love this conversation. If you want to, let's say, give an advice, Ed, to a beginner investor, what would be your, advice to them? If they are not sure that they want to start investing, should they choose stocks? Should they go ETF, or what?
Yeah, so particularly with my approach in particular, this was, so someone's asked me about how I invest, and then they ask, oh, well, what do you reckon? Then number one would be only invest the money you can afford to lose, because you probably will at some point. You will, and so it can't be mortgage money, it can't be car money, it can't be food money. This is going to be stuff you can afford to lose. Number two is be prepared to play that long-term game. If you're going to do it how I do, 6 months is nothing. A year is nothing. You got to be prepared to go 5 or 10 or 15 years, because if you're going to invest in, like I do, and you need that money sooner, you've got to pay a much closer eye on it. It sounds like what Steve does. Whereas if you're going to set it and forget it like I do, you've got to be prepared to wait. And then number three was, don't be afraid to use a paid investing recommendation service. There's no prizes for doing it all yourself, and no medals for not asking for advice. I pay for the Motley Fool, and the money that I've paid to them has more than paid for itself many times over, because they have teams of analysts and expertise and access to information that me sat in my kitchen just is never going to get hold of. So it would be foolish to think that I could do it better than they could. And obviously I tailor their advice and use it to suit me and my convictions. But yeah, don't be afraid to go and ask for help.
And the funny part, I want to just add to what Ed was saying, is that even those analysts, they rely on other services like Bloomberg, FactSet, and all those companies. So definitely use those services. How about you, Manos and Steve? Go ahead, tell us about your tips for beginners.
My tip for beginners, obviously, I totally agree with Ed. Only invest money you can afford to lose. Don't invest money that would buy you groceries for the month. That's not advisable, obviously. My other advice would be choose your investment platform carefully. Depending on how much money you want to invest, fees can eat through that money really, really quickly. So if we're looking at a company like Hargreaves Lansdown that I know Steve uses, they're a fantastic company, but they will charge you £9.90 something per trade. So if you are investing £100 a month and you buy one stock or one ETF, they charge you 9%. That's 10% immediately that you lost. So, and you have to pay that £9 again when you sell. So you need to make up that 10% and that extra 10% when you will be selling. So probably a low-cost platform is better for you. However, if you're investing larger sums of money, then that's pretty much a drop in the ocean. However, you do get what you pay for. The amount of information that a platform, a paid-for platform, gives you is so much more and so much more in depth as well compared to a free trading platform. Also, yeah, look at ETFs, but if you do have any ethical considerations, any ethical reservations, make sure that you look at the holdings of ETFs. A lot of the S&P 500 companies are making weapons or tobacco. If you're not into that, probably that's not one to look at. There are flavors of ESG, S&P 500 type ETFs for you to look at. That's another thing to be very aware of as well.
Awesome. How about you, Steve?
Well, so as not to go over the same old stuff, I would basically say that if I was a new investor, I'd probably start off with ETFs and slowly build up my confidence, and then maybe cherry pick some of those companies that are doing well, buy them individually. So as they call it, it's called a satellite portfolio, where you have your main ETF, and then you have a few stocks that you've purchased. And then, as I say, as you build more and more confidence, and if you join a sort of something like Motley Fool, which Ed's obviously explained, which is a very good company in my personal view, they will send you things like that they call them hot stock tips, and then I think they're called ice ones. So these are like long term is ice, and hot is they might do well quickly. Well, whether they do or not, that's something that's a risk you've got to take. And investing is all about risk, but obviously the more knowledge, the more research you do, fingers crossed, you'll do well. So yeah, that's about all. Have a budget and don't spend money you can't afford.
Awesome. And we also have an audience from Rasta Stocks. He says, do your due diligence and research, and of course, dollar cost average. So those are also very important tips for beginner investor. I think apart from what you guys have touched, I guess what I'll just say that if you're looking at investing, don't consider investing as gambling. So though I agree that only invest what you're supposed to lose, but don't go in the mindset to gamble. If you gamble, you will lose 100%. Not every time you'll because house is you're playing against the house, right? So don't
the
gamble.
House always wins.
House always wins. And I think the second is I think one of you guys touched it. Only use the money. Don't use your grocery money. Don't use your mortgage money. But make sure that you pay yourself, which means that take that money out, whatever you can. If you can afford $1, take that dollar out and consciously invest, because without investing, you will not grow your money. Because end of the day, no matter which company you work for, if you are working as a full-time, a professional, the company eventually you will retire, or the company will let you go, and you will have no money. So you have to, in order to make money, you have to invest, and don't go with a mindset of, you're going to lose the money. So don't gamble. That's
I think that probably just reminds me, actually, my favorite thing to do when someone asks me about investing is to give them a compound interesting calculator and let them have a play around.
Yeah.
Because when you see what those numbers pop out at, that's when you really get interested in investing.
Yeah. I totally agree. And I think for Ed, Steve, and us, because that's why we are here, I guess, because we enjoy investing. But even if you don't enjoy investing, listen, I mean, that's the only way you can grow your money. There is no other way. Whether you're investing in real estate to grow your money, whether you're investing in crypto, stock market, you have to invest your money somewhere in any asset class to grow. So I think we also have we have a question. He said, Rasta asked, what streaming platforms do you use? Oh, we are using StreamYard, Rasta. Any other guys, any other questions, because we know we have 3 minutes to go before we wrap up. Any closing thoughts from you guys?
That's a question I had. Manos touched on it, and it's quite an interesting one to me around the ethical side of index investing. It's not something that's talked about. I mean, Manos, what are your views on that side of things, investing in an ETF?
Look, I am politically, I'm to the left, very left, actually, but I'm also very cynical. So I would say that yes, if you buy an S&P 500 ETF, you will have the likes of Lockheed Martin and General Dynamics in there, which we all know what they make, and we all know how governments sell those things that they make to other countries and for what purposes. However, at the same time, if you look at companies like Amazon, we all hear the stories that are coming out that warehouse workers don't even get a break to go and relieve themselves. So if you want to find reasons not to invest in a company, there are plenty ethical reasons for every company under the sun.
Absolutely.
There are companies that you wouldn't even consider that are hand in hand with the military. So it really depends how deep you want to go to that. And each and everyone's moral compass is different. So
if I can add, Ed, there are like investors, especially it's like if you're larger investors, they call it sin stocks. So they specifically instruct investment companies not to invest in sin stocks. But if I invested in Diageo, it will consider a sin stock. I invested
Yes.
in Altria. It's a company that makes, I think, cigarettes. That's a sin stock. So yeah, I think that's a very, very, I guess, loaded question. It really depends on your moral compass. Where
Of
do
course
you
it does.
land.
Yeah. And everyone will sit somewhere on the spectrum of what that
Yeah.
means to them. And like Manos says, with your biases, it's very easy to turn a blind eye when you want to turn a blind eye.
Yeah.
And to be honest, if you have a large company like Apple, Amazon, they are no longer they are not I would say innocent either, right? They
Yeah,
have
exactly.
a ton of
Yeah.
complaints. So it really depends.
Yeah, I mean, from my point of view, I'm always for the future. So I would invest in renewable companies. I'd never invest in sort of Exxon or somebody like that. I mean, you could probably make some money on them, but that's not me. The same with tobacco. I wouldn't invest in tobacco. And most recently, the one company that I will never ever invest again, and this is just a personal opinion, and that's Facebook, because of what's been going on with that. So I say we're all different, and we all have our reasons. Yeah.
That's kind of the angle I was taking, I guess, with the kind of question is that by investing in individual stocks, it gives you that touch more control over what you do and don't invest in, I guess.
Absolutely. I totally agree with that approach. But to be honest, I mean, in my personal, I don't go the ethical route. I'll be honest. I'm trying to grow my money. So, if I try to be ethical and only invest in certain companies, then my growth will be hindered. I mean, but that's everybody's for themselves.
Yeah,
of course.
Sure.
They should choose whatever they like.
Yeah.
But thank you so much, guys, for joining. This was amazing. If you guys want to stay on, we'll end the broadcast here. And thank you so much for everyone for watching. Thank you so much.
Thank you very much for having me on. Cheers, guys.
Thank you.
Thanks.